and welcome to the Tax Roundup for November. And the one thing we can rely on as accountants and advisors is the constant state of change. And this month is absolutely no different. We're going to take a look at the tax rate reduction, the accelerated reduction by 5 years for small business. That legislation went quickly through Parliament. We'll look at the implications of that and what you need to be thinking about now. We're also going to take a look at what to do if your client is compensated by a financial institution and what to do with that income coming out of that. But first up, a very important change. We're looking at the Division 7A changes that are being flagged. Now, these changes are quite significant. And while it's only consultation at this stage, they are intended to apply early next year, so it will be incredibly important to get your head around what these are and what the implications will be for clients. Across to Michael Carruthers.
Now, over the last two federal budgets, we've seen some announcements from the government suggesting some pretty significant changes are on their way in the context of Division 7A. We've finally now got a consultation paper from Treasury setting out a bit more detail about what those changes might look like. Now, it's important to remember that this is just a consultation paper at the moment. No draft legislation, no final legislation. So what finally gets passed might look quite different to what we see at the moment. But if you have any dealings with Division 7A, if you have clients who are private companies or have connections with private companies, it's important to start getting your head around where things look like they're going. Because the proposed start date for a lot of these changes is 1 July 19, and that's not very far away. Now let's have a look at some of the key things that are in that consultation paper and where Treasury looks to be heading at the moment. First thing is Division 7A loans. Under the current system, one way of preventing a deemed dividend from arising under Division 7A is to put in place a complying loan agreement. And you have two main options, a 7-year unsecured loan or a 25-year secured loan. Now what Treasury is suggesting is no longer having two options, basically having a single option for complying loan agreements, which would be a 10-year loan. A 10-year loan with interest and principal repayments being made over the life of that loan with reference to a specific interest rate. Now, what Treasury is suggesting is that existing complying Division 7A loan agreements will be transitioned into these new rules. So if you have an existing 7-year loan agreement in place, you'll move into the new system, but with the same end date of that loan agreement. It won't be extended. For those who have current 25-year loan agreements in place, they will also be transitioned into the new arrangements, but that will take place over a couple of years. But what it means is that for existing 25-year loan agreements, the actual loan term might end up being a fair bit shorter than what clients currently think they have. And that could have a pretty significant impact in terms of cash flow and how those repayments are going to be made. The other thing that Treasury is looking at doing is basically refreshing old pre-1997 loans. If they haven't already been forgiven or deemed to have been forgiven under the statute of limitations, then again, what Treasury is suggesting is those will now be brought back within the scope of Division 7A. We'll need to be very careful about those. Another significant change is Treasury is planning to scrap the concept of distributable surplus. So what that means is you'll no longer have to worry about doing complex calculations, but there is a much higher exposure, potential exposure to deemed dividends for clients. So at the moment, let's say a private company makes a loan to a shareholder of $100 and no loan agreement's put in place, the loan's not repaid. Well, what tends to happen there is we have an unfranked deemed dividend of $100. But the next step is we calculate distributable surplus of the company at the end of the year the loan was made. And the deemed dividend will be capped at the distributable surplus. So if the distributable surplus is nil, then the deemed dividend is nil, and you don't have to worry about paying tax if you're the shareholder who's received those funds. But what Treasury is planning to do is scrap that concept altogether. If a $100 loan is made to the shareholder and it's not put under a complying loan agreement, it's not repaid by the relevant deadline, there is a deemed unfranked dividend of $100 regardless of the balance sheet position of the company or its financial position. So very significant change, which really will have to be thought through quite carefully when it comes to loans being made by companies in the future. Now, one of the areas that came out of this year's budget was how we deal with unpaid present entitlements, and the government clearly wants to change the way that currently works. At the moment, there's a couple of different ways of dealing with unpaid present entitlements. Again, what Treasury is suggesting in this consultation paper is that an unpaid present entitlement will basically be treated just like a loan. So unlike the current state of play where we get this 1 year grace period, and then we have to try and figure out what to do with it in terms of loan agreements or repayments. The proposed changes suggest that unpaid present entitlement will need to be dealt with in the year following the year that the resolution or appointment of income arose. So you'll have a much shorter time frame to put in place that loan agreement or have that unpaid entitlement actually paid out. The Treasury is also suggesting that, again, a transitional period would apply so that existing UPEs that arose on or after 16 December 2009 will be brought into this system as well. So if they're not already under loan agreements, for example, you might have some sub-trust arrangements in place, it looks like those will need to be brought in within the scope of the Division 7A loan agreement rules. There's a bit of a question mark over pre-16 December 2009 UPEs. The consultation paper doesn't really go into that in any detail, but there is a question, as one of the discussion questions, as to whether people think that those older UPEs should be brought within the scope of the full Division 7A rules or not, or just left the way they are, which is potential exposure under subdivision EA. One of the other big changes that we potentially see is the way the amendment period rules work. Now, Division 7A amendment period rules, typically you get a 4-year amendment period. So even if you're subject to a 2-year amendment period, if something arises under Division 7A, that's normally extended to 4 years. But what Treasury is planning to do is extend that from 4 years up to 14 years. So that would be basically your 10-year maximum loan period plus 4 years. And again, that will mean that it's much harder to avoid Division 7A by saying, well, something happened 5 years ago, we've only just realised it now, but we're outside the amendment period, so we don't have to do anything about it. That 14-year amendment period would mean that prior year problems will probably need to be dealt with quite differently. Now, kind of consistent with that is also this potential change that rather than asking the Commissioner for his discretion to fix up Division 7A problems, you'll be able to do that on your own. So you identify a Division 7A problem that has existed in the past, and what Treasury is suggesting is that you can fix that up. You can make repayments, catch-up payments, declare all the interest that should have accrued over that loan, and you don't have to go and ask the Commissioner for the permission to do that. You can basically self-assess that corrective mechanism and apply it yourself as long as you take appropriate steps to do so. So they're the main changes that are being suggested anyway in the consultation paper at this stage. There's a number of other minor changes as well, so we are likely to see a lot of changes come through when we finally get some legislation on this. Treasury presumably will be gathering submissions that are made on this, reviewing them, and then come up hopefully with some draft legislation at some point in the relatively near future, given we've only got 6, 7, 8 months before that proposed start date. We'll certainly keep you updated. It looks like there are some major changes coming in this area.
Now across to those company tax rate reductions.
Now, after all the delays and uncertainty around changes to the company tax rates and franking rules over the last few years, it was a bit of a surprise to see some legislation speed through Parliament in record time, giving smaller companies further tax cuts from 2021 year onwards. Now, these were tax cuts that were actually already legislated, but the government has decided to bring them forward basically 5 years. So the 27.5% lower corporate tax rate that applies at the moment will continue for the 18-year, 19-year and 2020 income year. For the 2021 income year, the rate will drop from 27.5% to 26% for companies that are base rate entities. That rate will only be in place for 1 year. From the 2022 year onwards, the rate will drop down to 25%, where it will stay for the foreseeable future. Franking rates, maximum franking rates, will move in line with those corporate tax rates as well. So from 2022 year onwards, some companies will be subject to a maximum franking rate on their franked dividends of 25%. Now, there's good and bad bits to these changes, as people are probably starting to recognise, given the changes that have already gone through the system. The good thing is if you've got a company that's making profits and you want to keep those profits in the company, well, lower corporate tax rate means there's more cash to spend on the business, invest in business growth, etc. The problem comes when you're trying to take those profits out of the company, because a lower corporate tax rate for many people is just a timing benefit. When the money comes out and flows through to the shareholders, there's probably going to be some top-up tax to pay. Unfortunately, there will sometimes be double tax to pay. And this is something we need to be very careful of. And again, something that people are starting to get their heads around, given the already reduced company tax rates over the last few years. And the problem arises when a company has paid tax at, say, 30% or 27.5%, but dividends are paid out maybe in a future year when the maximum franking rate is lower. So you might have a company that's paid some tax on profits at 30%. We move forward to 2022 and maybe that company's maximum franking rate is only 25%. So the credit for tax already paid by the company on those profits is lower than it would otherwise be. And the shareholders are the ones who have to basically pay the top-up tax on that. Arguably, there's an element of double taxation that arises. The problem then is you've got this company sitting there with some excess franking credits that it might not be able to use. They're basically wasted in some cases. Now, there may well be strategies to reduce the impact of that double taxation and that wastage of franking credits, but we will need to consider that on a client-by-client basis and think through how these rules are likely to look and what the position is going to be over a number of years so that we can plan ahead for that. Now, the government has also changed the way the small business tax offset rules work for sole traders, partners in a partnership and beneficiaries of a trust that carry on a business. The tax offset, which is currently 8%, that will move to 13% for the 2021 year, and it will then move to 16% for the 2022 year onwards. However, the maximum cap is still $1,000. So for some people, that change in percentage won't make any difference to what they get as a reduction in their tax liability. So a higher rate, but the same cap of $1,000 is still likely to apply. So there's a fair bit to take into account. Again, that looking ahead in terms of where tax rates are moving, but where maximum franking rates are moving as well. Understanding how the base rate entity rules work is really important too. A base rate entity is a company that meets the aggregated turnover threshold, which at the moment is now $50 million, and it will stay that way again for the foreseeable future. And we have to look at that 80% passive income test. So as long as aggregated annual turnover is under, say, $50 million in, say, the 2019 year, the lower corporate tax rate will apply as long as no more than 80% of that company's total assessable income for that year is classified as base rate entity passive income. And we're seeing a lot of examples of people who are maybe getting a bit confused about what is passive income or not. We need to kind of get away from what our traditional notions of passive income might be, because things that you might think are really business income might be classified as base rate entity passive income, and vice versa. Things you think are passive income, like some dividends, might actually be treated as non-passive income for the purpose of these rules. Really important to understand the rules well in the context of, again, your client's company and the type of income that it produces and derives. So lots going on in this space. It looks like we've probably got a fairly settled position, at least for a number of years now. We can actually start to plan properly, and planning will be really important when it comes to these changes.
Now to those compensation payments from financial institutions.
Now, over the last couple of years in particular, and we're going to see more of this as time goes on, I've heard lots of stories of people receiving compensation from banks and other financial institutions to compensate them for maybe advice they didn't get or for poor advice that they did receive. And the question that comes up from a tax point of view is, how do we deal with those compensation payments? Well, the ATO has issued some guidance around that, and it won't cover every single scenario that you come across, but there is some pretty wide-ranging guidance in terms of the typical situations that you'll probably encounter most of the time. Let's just break down where that guidance goes. So first of all, the ATO looks at compensation that might be received by someone because of a loss of investment or value of investment. So some advice has led to someone making a poor investment or making less money on that investment than they would otherwise have made. And the ATO says in that case, you need to look at whether this is an investment that is still held by the taxpayer or something that they've already disposed of. And in this context, it seems to be assumed we're dealing with investments held on capital account. The ATO says that if you still hold that investment, then probably what will happen is you'll reduce the cost base of the investment by the compensation you've received to compensate you for the loss in value of that investment. But where you've already disposed of that investment, the ATO says that that compensation will typically be treated as additional capital proceeds for that disposal. So if a client has already lodged the tax return recording that CGT event they might have made a capital loss or maybe a relatively low capital gain, well, you'll need to factor in that compensation amount as additional proceeds, which is probably going to change that prior year tax return. In some cases, people are receiving compensation to recoup or reimburse them for fees that they paid, advisor fees they paid. In that case, the main question is, has a deduction been claimed for those fees? If so, then it's quite likely that that compensation amount will be treated as an assessable recoupment. It'll become assessable income. Basically, it reverses the deduction that might have been claimed in a prior year or even the current year. Alternatively, it might be a situation where the advisor fees couldn't be deducted but have been added to the cost base of an asset. Now, if your client has received a recoupment of that amount, we need to then reduce the cost base of that asset or investment. The other thing that people often are receiving is an interest component, some sort of payment or a component of the payment that represents interest. The ATO says if part of the payment or all of the payment represents interest, just treat it as assessable income in the year in which it's received. So a range of different scenarios you might encounter. We've got some ATO guidance now in terms of how we deal with the tax treatment of those compensation payments. If the situation you come across falls outside those pretty common scenarios, well, you'll have to go back to general basic principles and see, well, what is it that this compensation actually represents before you can then figure out what the tax treatment of that might need to be.
And that's the tax roundup for this month. Remember, if you want to keep on top of change and you're not a member of Knowledge Shoppers yet, then take a look at what the membership service offers. Just give the team a call on 1800 800 232 and they'll show you exactly why thousands of accountants across Australia are members of Knowledge Shop. We look forward to talking to you soon. See you next month.